Hey there, this is Bill with smarttrades.com. Today is May 27th, Monday, Memorial Day, and it's about 1:45 p.m. Pacific time. And as always, if you would like more frequent updates, please visit me at smarttrades.com. In fact, we just did a couple of reports. Those would go out free to anybody that subscribes in the next couple of days. And again, that's smarttrades.com. I pretty much update about anywhere from 3 to 5 times a week, as well as a bi-monthly stock report that talks about high yield stocks as well as long-term trends in the stock indices. At any rate, here's my long-standing count in the S&P. Some of you long-time subscribers may remember that I've had a variation of this count dating back 3 years. In fact, if you would go back to, you can search my channel for the April 25th, 2010 video, long-term Dow Elliott wave alternative to Prechter and others. And here's a screenshot actually from that count. This is, again, this was actually put out back in April 25th to be exact, 2010. And at the time, there are a lot of folks that were extremely bearish, Prechter and others calling for a C wave down, calling this A, B, and that we were going to go C wave all the way back to the previous fourth wave low somewhere around Dow 40. Now, could that happen? As we stated then, sure it could. I mean, there could be some horrific kind of tragedy and disaster that could make that happen, but I just don't see now and then, that particular scenario developing. One thing that you will notice, a lot of folks have suddenly come to the conclusion that the current rally is a B wave. And again, this is back in April of 2010. We talked about the expanding triangle possibility. I apologize for the quality. This is a screenshot from that 2010 video, but we talked about the expanding triangle then, A, B, C, D, and E, and a correction that still had years to go and was more or less a sideways pattern rather than a deep crash pattern. And as some of you may be aware, a lot of folks, famous and otherwise, have suddenly come to the conclusion that the current rally is indeed a B wave, or that this is an expanding triangle. I don't favor this as an expanding triangle, and I'll show you the details in that in just a second. Anyway, back to the current S&P. One thing of interest, if you will look back at the 1973-74 market, that market expanded. Let's take a quick look at that. I happen to have the slide here. This is, I believe, counts best as A, B, C of A, B, C of B, and then a C wave down. You will note that the B wave expansion was just about right on the 1.272 expansion of A. A lot of folks will wrongly use the 1.382 expansion. 1.272 is the actual Fibonacci expansion, and it works something like this. The square root of 0.618 is 0.786. The inverse of that is 1.272. 1.382, although it looks good, is not actually even a Fibonacci ratio. If you do the math, you'll see this for yourself. But anyway, the 1973 peak, 1.272 times A. Now, if we're replaying that particular scenario, and we've got an expanded flat A, and we're working on B now, this market could go all the way up to about the 1780, 1800 area basis the S&P. I don't know that it's going to get that high, but it's certainly worth noting. Again, that would be more or less a replay of the 73-74 pattern. And we obviously have blown out the previous high at B at around 1576. Was wrong with that particular projection. However, the basic scenario of a B wave peaking or heading towards a peak in the not so distant future, I believe is still the best count. One thing to note also, talking about the expanding triangle scenario, a problem I have with that is that this decline, the decline to the 2009 low, best counts as a 5-wave structure, an impulse down, a C wave termination of A, rather than A, B, and a corrective style, non-impulsive, non-5-wave C wave in an expanding triangle. And we've already blown out the upper channel, by the way, on the expanding triangle. Again, not something that I'm completely against. I actually had looked at that as a possibility back in 2010. Here again is that 1970 bear market pattern. Again, we have the expanding A, B wave to 1.272 times A. And whether or not we get exactly there or not, I believe that we're more or less replaying that 1970s bear market, but just on a larger scale. Here's a more detailed view of the current market. And basically I've got this as a double zigzag, nice 5-wave structure of A, B, C, of W, X, A, B, and C. Now, it's possible to count this in a variety of ways. This is one of the problems with B waves in general and corrective waves in general as well, is that there's oftentimes a large variety of potential possibilities. B waves are particularly notorious for being hard to count because they can unfold in a vast variety of ways. At any rate, we do have resistance just overhead here. And again, this is can be counted as a double zigzag here, ABC, X, ABC. You have a nice 5-wave structure that could be completing. Or we can count this as A, B, 1, 2, 3. And again, we have that 5-wave structure. If this is the case, if indeed we still have another high to make, and we are going to go up and test 1700 plus and maybe even that 1780, 1800 area as the scenario was in the 1970s and 1973 to be exact. We'll probably find support on the next decline around 1576. Again, that's the previous all-time high, or perhaps down to around 1535. That's our short-term 4th wave low support. Okay, so again, A, B, C, X, A, B, 1, 2, 3, 4, 5. And it's also possibly complete in actually a double zigzag. I don't have the internal labels exactly correct here, but you get the idea. Either we're peaking now or we're peaking later, so to speak. But the key will be watching how the market reacts around the 1576, and preferably that about 1535, 1540 area. Here's the shorter term S&P. And here's the, we actually did find resistance initially on several occasions around that 1576 area. We eventually took it out. And one of the keys to seeing that we were going to probably go through there was the fact that when we did break out, the decline from the breakout up to about 1597 and then the drop back to about 1535 is best counts as an ABC decline, and it held at previous support. Not a perfect 5 up from there internally, but I think it does best count as an impulsive wave. You can see the divergences on the high. You can count the internal 5-wave structure within the small degree 5th wave, as well as a possible 5-wave structure from about the 1535 area on wave 4. Also worth noting here, we have broken the short-term trend line. We've made new short-term lows in breadth, and so far the rally back up off of those lows appears to be corrective. So certainly the potential here for either a short or even a longer-term top developing. Resistance comes in ideally around the 1662 area. That's a nice little combination of pivot points, as well as about a 50% retracement and a little bit more than an A equals C off of this low. Also of note here, on the way up, all our little small previous 4th wave support levels tended to hold. For the first time, we do have, at least on a very short-term basis, not only a break of that trend line, but a break of these other small short-term swing lows. and the break can be counted as impulsive. It's not absolutely impulsive. The futures look somewhat ambiguous, but it probably counts better as an impulse down than a corrective decline down, at least to this point. Moreover, and this is important, with a relatively impulsive looking decline, the rally back up best counts as a corrective rally. It's certainly taking more time and has less momentum up than it did on the downside. Resistance is kind of the inverted previous fourth wave here towards the 1662 area. Again, that's about a 50% retracement of this decline. 62% comes in around 1667, and finally there's a previous target and also a 78% retracement. Again, that's the square root of 62%, comes in around that 1676 area. If the market were to blast through 1676 and close above there, I think that'd be a pretty clear sign that the probabilities now favor new highs, and that this count of a wave 1 down, wave 2 back up type peak is probably wrong. NASDAQ also can be counted as complete or nearing complete, at resistance right now on several degrees of scale. I won't bore you with the details, but you can see the calculations right here. We're also into a time frame where we have some equality in the in this grayed out count, where we have A equals C in respect to time, and 78.6 of A in respect to price, as well as some internal calculations. Now, if we blast through there, the next area for the NASDAQ could go all the way up to about 3,400. But as always, one step at a time. Right now, I do believe we've got a short-term peak. Switching gears a little bit, here's the euro. For, again, years and years, I've talked about the possibility, or the probability, I should say, that I think that the euro and the dollar are actually in contracting triangles. I think that's still the best count. Clearly, we have an A, B, C type pattern down, A, B, C type pattern up. C is a little bit more convoluted, but clearly overlapping and looking corrective on the way down. Another ABC back up, and perhaps we're working on still a D wave back up in this triangle, and perhaps we need another series of ABCs up to complete the pattern. Support comes in down around 124 or so for this this decline, assuming that it indeed is a corrective decline that's going to hold. It is possible you can count this as a D wave complete to this point. I don't favor that. It's not at the long-term trend channel, but it's possible. Here's a little bit more of an expanded view again of the euro weekly, and again the clear cut ABC up, A, B, C, and probably an ABC down. Another set could take us back up towards these trend channels up in the 142, 146 area, possibly to complete our D wave in that contracting triangle. Crude oil, a very similar scenario. I believe, again, this is a corrective, probably a triangular type pattern. Here again is the classic three-wave structure up in A, B, C, and B, and I believe C still unfolding, and probably, obviously, another ABC. And these trend lines can be adjusted over time, but again, the main message is the clear-cut corrective patterns, both up and down, both in the currencies and in crude oil. Natural gas, I believe we may be forming a short-term corrective peak here, although we'll see. That's I do suspect that there's going to be a longer-term rally in the not-so-distant future in natural gas, but this trend channel and also this potential 5 waves up in C is forming a potential top in natural gas. Gold. The gold pattern from the top here at B is a bit of a mess. I can count it as 5 waves down. 1, 2, 1, 2, 3, 4, extended 5th, 3, 4, and then a possible 5th developing here. And again, let's look at this decline. The initial decline, to me, sure looks like an A, B, C of A. We have A, B, C of B. And again, this is kind of a mess in C, but we're right at a support. We've got a parallel channel. We've got a possible 5 waves down, or you could count it as a some kind of zigzag as well. We could rearrange the labeling, but the bottom line is currencies, crude oil, gold, I think they all count best, like the stock market, as being in long-term sideways corrective type patterns. Bonds, here we go again. A, B, C of A, B, C of B. Kind of a mess in C, but again, the overall pattern is corrective off of the highs. And until proven otherwise, I'm going to stay with that idea. Not to say I wouldn't look for places to sell bonds or stocks. Obviously, the stock market is getting close to a potential termination in B, and indeed, I think we may have even topped. But as far as currencies, bonds, crude, and so on, I think it's best to count them in that corrective sideways pattern. TLT, same kind of thing. Again, A, B, C, an overall corrective looking pattern. A little more bearish than the bonds themselves, but worth noting here we are at getting back down to support at the lower end of this corrective pattern. And as some of you know, I also do individual stocks, and in particular what I've been looking for is high yield stocks with yields so precious lately. And I use basic Elliott wave theory, more or less I would say a pattern recognition type philosophy, rather than looking for extreme minute details in terms of Elliott wave patterns. And in doing that, I look for low risk opportunities to get into the ongoing trend. In FUN here, a very good example, we had a nice little wedge corrective type pattern. Again, you can see the telltale ABC and ABC up, another ABC down, and then we broke out of this wedge. This was about a 6% yield when we first started looking at it. I make no claims to actually making any of these trades or any of my customers making profits and so on, purely educational. Nonetheless, here's the pattern I was looking for the breakout or the test of the lower channel. About a 6% yield when we first started looking at this. And then, in the words of Ed Sakota, the trend is your friend until it ends. And oftentimes we don't know when it's going to end. So my philosophy here is to raise your stops. If you want to hang on to yield and let your profits run, I'd leave the stops down around 36 for fun. Raise those stops a little tighter because after all, this we do have about a 30% rally from our breakout point here. HPT, similar scenario. We had a larger scale wedge type pattern, and then these small scale breakouts along the way. Once again, trailing the stops up. 6% yield when we first started looking at this at smarttrades.com. And by the way, that bi-weekly stock report is only $19 a month. It does include some other analysis, and sometimes there are more frequent updates there as well. And that's a new service I'm offering at smarttrades.com. That service is included with the regular service, by the way. Anyway, again, same philosophy, bringing up the stops. If you want to hang on to that yield and let this run for a while, have a break-even or better stop, perhaps up around 25. And if you want to protect some profits, you start to notch these stops up a little more, because once again, about a 30% rally out of these breakout points. UPS, we actually had one of our trailing stops that we proposed on the newsletter hit, but nonetheless, nice 15% rally from our breakout point. Once again, the wedge pattern, a small scale breakout pattern within that, hopefully to lower risk. We use the breakout of that, put a stop just below it, and then ratchet our stops up as we go. And once again, UPS rallied from when we first started watching it, it was down around the low 70s, and it recently started testing the 90 area. And finally, Campbell's soup. Good. Anyway, This Campbell Soup had a corrective pattern, consolidation, actually a false breakdown here. It failed to break out initially out of a nice little triangle pattern. And then a secondary, even smaller scale triangle broke out of that longer term pattern. And once again, nice strong rally. This had a somewhat smaller yield, about 2.5% when we first started looking at it. But nonetheless, a nice rally in addition to the yield. And you know, we don't know when these things are going to top, so I use a little bit of trend following technique here to raise the stops and let the market take me out when it's ready to reverse. Anyway, that's it for now. Hopefully you had a good long weekend, and I wish you a great week ahead. Again, visit smarttrades.com for more details, more frequent updates, and to subscribe to the Smart Trades update, which comes out just about every day. Thanks again. Bye-bye.